Let's go ahead and get started here. Thanks for coming, everyone. We're here today to talk about how you can prepare for the potential acquisition by Alphabet, Google, of Wiz. And we're Secfi Wealth. We're a part of Secfi, who you may have heard of in from the options financing and analysis side, but we also have a wealth management financial planning group, and you're looking at them. So this is the team here. Today, I'll be speaking along with my colleague Eric, who's a lead financial planner and advisor. My background is in investments, so I'll be kicking things off and talking a little bit about what we're doing here today, but Eric will be running with the bulk of the presentation today. We also have the rest of some other folks on the call from the Wealth team, Tim Lee, Mike Allred, and Stephanie Johnson Fuentes, who are all here to provide support and answer your questions as you type them in. So feel free, you don't have to wait to the end. You can lob questions at us along the way. We'll try to answer them either through speaking or in the chat. And yeah, so thank you to the rest of the team here as well. So, just to get started with some disclaimers, and this is important because this is educational in nature. This is not advice for you in your specific situation. This is informational. You should consult with a professional advisor about what you should do for you. And what someone does for themselves may not be applicable to you because there's a lot of considerations that go into the right decision for the right person at the right time. So, just a disclaimer, this is educational in nature. I hope that it's valuable and it gets you started on your path towards making a plan and executing that plan. But do remember that you should dive a little deeper beyond just what we say here today. Okay, so what do we do here at SecFi? We have a few different offerings. We've got some DIY tools that are free to use on the website that help you evaluate your options, maybe the tax implications, what you might walk away with under various scenarios. You're welcome to go to the website, use those tools to analyze, potentially what you might get out of the Wiz acquisition here. The team here, we do wealth management financial advisory. So if you're looking for more specific guidance, one-on-one, and holistic financial planning, we're the folks for that. And then the broader SecFi entity does financing. So we put up the cash for folks to exercise their options in certain cases. May not be as applicable for Wiz, given the acquisition is coming up. Um, Hopefully sooner rather than later. Well, actually, maybe hopefully later rather than sooner, depending on your perspective. We'll talk a little bit about that as we go through the deck here today. Okay, so where are we in the timeline? Sometimes these acquisitions can take a very long time. We just had the announcement not too long ago, so we're really at the beginning. And it'll take months, most likely, before we get to a place where we know if regulators have approved the deal. So the DOJ, the FTC, they're going to be interested in this. They're going to be examining the deal and has to pass their tests in order to go through. Once that regulatory approval does go through, typically by then all the ducks are in a row, and it usually takes just a short amount of time, days, weeks, before the transaction closes. According to Wiz itself, that is expected in 2026, but that's as specific as it's gotten. So, 8 or 9-ish months at the earliest, maybe a little bit longer, until the transaction closes. And once it closes, the cash usually shows up in your account within a few days. So that's the sort of timeline that we're looking at. Probably, 9-ish months to maybe a little bit longer than a year. But there is obviously some uncertainty about that because these things can drag on depending on the market environment, the regulatory environment, et cetera. So you've got some time, but you should start now. And, by virtue of attending this webinar, you are starting now. So we applaud you for that. Now, when you're thinking about your equity and what you should do, just remember it's pretty complicated. There's a lot of jargon, a lot of three-letter acronyms. Uh, it gets pretty complicated pretty quickly. There's different types of equity, different types of taxes, different tax rates. It can depend, factors like where you were living when your equity vested can matter, where you were living when you sell it can matter. There's a lot of inputs into the decision. So if you're finding yourself overwhelmed or confused, don't sweat it. Like this stuff is pretty complicated, and it'll take some time and maybe some advice and help from others to make a really informed decision. So how should you handle your equity? Well, the first step is to get educated about the implications of what you might do. And that's, what you're here today to start with. So hopefully this is educational and we can start you on your path. But don't let this be the last thing you do in preparation for taking some action with your equity. You actually need to create a plan and follow through, and then potentially even adjust if things change along the way. So, this is just the beginning of how you should handle your equity. Gaining knowledge is always good, but it doesn't help unless you actually take some action in the future. And we encourage you to go beyond just learning about it and put it into practice too. So with that, I'm going to turn it over to Eric, who will walk us through the meat of the presentation here. He's going to start with generally forms of different types of equity compensation. We'll talk about taxes, including different types of taxes and different taxable events related to equity compensation. We'll discuss making a plan for your equity and some things that you should consider, and then we'll talk a little bit about the bigger picture. Hopefully this is a nice windfall for you. Maybe it's setting you up and letting you achieve some financial goals. And we'd love to give you a framework for how to think about that kind of thing as we go through the presentation here, because, what's money for if not to live your life and live it the way that you want to live it? So, with that, I'll turn it over to Eric, and Eric's going to start by discussing the three different main forms of equity compensation. Go ahead, Eric.
Yes, thank you so much, John. And thanks for joining everybody. So to kind of start and think about this at a high level, these different forms of equity compensation, what's their purpose? We're diving into that a little bit, simplifying a bit of the jargon, providing a bit of the education on the back end, and hopefully making things a bit more simplified, give you greater understanding of this acquisition that's set to occur. So at a high level, this equity compensation are really tools used for retention. Longer term vesting schedules allow for greater retention of employees and incentivizing longer term employees, and really aligning incentives between the company, management, and employees to have them all thinking like owners, because ultimately you are getting to share in the upside and the rewards of company growth. The tax policy around these at a high level is built around these forms of equity education, or I'm sorry, equity compensation, as it pertains to a couple of things that the IRS and Uncle Sam are trying to accomplish. The first is trying to incentivize calculated risk taking. Ultimately, if you're willing to put your own capital at risk and your own skin in the game, especially in the case of exercising incentive stock options, the IRS is open to rewarding you with potentially preferential tax treatment. Similarly, encouraging a long-term ownership mindset. If you hold onto your shares and keep your capital at risk for greater than a year, the IRS is also open to rewarding your patience and alignment with longer-term company successes with favorable tax treatment. So in all these cases, it is our job as advisors and at Secfi to try and strategize around these tax saving opportunities and maximize their benefit for our clients. So diving right in, incentive stock options. You can think of these as an opportunity, or as the name implies, an option to buy company stock at a potential discount that's only available to employees. These options get a set price called the strike price to buy shares later on. And the key element that sets incentive stock options apart is the preferential tax treatment associated with the bargain element, or the amount between the strike price and where you ultimately exercise them at the fair market value. And the goal here is to try and get them taxed again at preferential tax treatment or the lowest tax rates possible. This is all assuming proper holding periods. So something we're going to be coming back to throughout the presentation is the required holding period associated with incentive stock options. That is going to be 1 year after exercise and 2 years after grant. That holding period allows incentive stock options to be taxed at preferential or receive federal capital gains, long-term capital gains tax treatment. As I alluded to earlier, big picture, when you put your own capital at risk, align your incentives with the company and hold long term, that's when the IRS is willing to step in and potentially offer that preferential or lower tax treatment. As it pertains to non-qualified stock options, NSOs, they're going to be similar in nature to ISOs, but with fewer tax breaks because they can be given to anyone, employees, advisors, contractors, less limitations associated with them, and very similar in structure where they're going to have an implied strike price or point at which you can purchase them, and there may be a gain embedded between that strike price and the fair market value at the point in which you exercise. That's going to be ordinary income tax treatment, and we'll dive into that a bit more shortly. And then restricted stock units. You can ultimately think of this as a bonus that comes in the form of shares. Instead of $100,000 hitting your paycheck, it's going to be, say, $100,000 in the form of shares. Now, what's important for you on the private side is restricted stock units are considered double trigger as opposed to single. And what does that mean? Double trigger is going to require two events to occur. One is time-based vesting associated with your vesting schedule as provided by the company. And the second is going to be some form of liquidity event, usually in the form of an IPO or an acquisition. Now, if you held shares in, say, Amazon, that's a public company, highly liquid, marketable security. So if you were at Amazon, received an RSU, once it vests, you can essentially receive income at that time. You could sell that share immediately. In private companies, that doesn't exist. So it does require that second liquidity-based event in order to actually get a market for that restricted stock unit in order to actually receive some income and be taxed on it, which again, we'll be discussing momentarily. So diving into the taxes next. At a high level, a taxable event occurs when income or implied income has been received. So, top to bottom, we can go through some examples here. So you have an incentive stock option that was granted. At grant, no income was received, no taxation. Once that option vests, again, no implied income at that point, no income has been received. But at exercise, that's where things start to get interesting. You start planning. The implied benefit within that point at exercise, there's going to be some differential between the strike price on that option, which you've been granted, and the fair market value at that time. So let's say, for sake of argument in this example, the strike price is $1 and the fair market value for that share at that time is $6. You have an implied benefit of $5 per share, also known as the bargain element, the spread in this case, and that is usually added back, or rather it is added back and considered income for alternative minimum tax purposes. We'll touch upon that on the next slide. But ultimately, that implied benefit that's built into an incentive stock option could potentially get preferential or lower tax treatment. Once those shares are retained and held, that's when you can start receiving the potential of long-term capital gains treatment. And again, everything in association with that holding period that I discussed earlier, again, held at least 1 year after exercise and 2 years after grant in order to try and obtain long-term capital gains taxation. When considering a non-qualified stock option, again, behaves very similarly, where upon grant, no income, no taxation associated with it. Upon vesting, again, no income tax. And upon exercise, that spread that I just discussed earlier, that spread for non-qualified stock options is going to be ordinary income tax. So a pretty large dispersion between a non-qualified and an incentive stock option, usually a fairly large differential in terms of how that spread, that $5 in the example earlier, is going to be taxed. Upon exercise, you retain and hold those shares. And from that point on, it's going to behave very similarly to if you had a brokerage account and had some level of upside in the future. 1 year holding period will gain you long-term capital gains rates, whereas less time will get you short-term capital gains rates or ordinary income taxation on the federal level. Lastly, as it pertains to restricted stock units, um, upon grant, no taxation, but as noted earlier, that second trigger is going to lead to the taxable event. So that second vesting or second trigger is when that income will be received. In this case, upon the acquisition, the shares that have vested will simply become income for you. Some things to think about, kind of, pulling this back up to a high level. All the way on the right, you see the act of selling. Again, as I noted earlier, the IRS is really looking to encourage you to put your own skin in the game and try to own and retain shares, and then hold them for a long-term time horizon or a long time period. It's that selling element where once you obtain, hold, and retain those shares and have it longer than a year, that's when the preferential tax treatment of long-term capital gains comes into focus, and we'll dive deeper into those tax rates next. So diving a bit deeper into the underlying tax rates, we see that there's a number of different taxes, a number of different things to be included here, from income tax, alternative minimum tax, short-term, long-term capital gains. So taking this at a high level, when you think about your ordinary income, the taxes you file on a regular basis, that will most likely fall into the regular income tax or ordinary income tax levels. Um, when you have a windfall such as this, large capital gains, a large liquidity event, you'll tend to trend into that level closer to that, call it 37%. Income becomes very meaningful and taxed at fairly high rates. So when you have the opportunity, or when you can strategize or plan around areas in which you can get long-term capital gains rates instead, prevents a really large planning opportunity, presents a really large area where you can try to reduce your taxes and ultimately keep that in your pocket as opposed to sending it off to the government. One thing we've been touching upon pretty often, talking about it at a high level, and you probably hear pretty often, especially if you hold incentive stock options, is this alternative minimum tax. Uh, really, to talk about it in plain English, it is a separate parallel system that runs in tandem to the regular tax system that you're likely familiar with. It is meant and designed to make sure that high income earners pay at least a minimum amount of tax. And it runs those calculations in parallel. You have the regular tax system, taking the normal deductions, standard deductions, things that you're used to. And concurrently, you have the alternative minimum tax system, which adds back a number of incentives and it calculates a separate tax bill. What's important here is that bargain element on incentive stock options. Again, the difference between the fair market value and the strike price is something that gets added back for the alternative minimum tax calculation. So you run these two in tandem, and when you have a year in which the alternative minimum tax bill is higher than your regular tax bill, you're going to have some AMT due, and that tends to fall in periods where you have large add backs from exercising incentive stock options. Uh, you know, as it pertains to the difference between federal and state tax rates, and again, we have California here for example purposes. For federal purposes, they will usually delineate between capital gains, whereas that tends to funnel into just standard income on a tax level. AMT is differentiated for California, but California is very unique as most states do not separate alternative minimum tax, and it will usually just funnel into ordinary tax.
One quick thing about AMT or alternative minimum tax. Way to think about that is that it's a prepayment of taxes. You
Great point.
are paying an alternative minimum tax on the spread. There's some other stuff that goes into it, but let's keep it simple. And then what happens from like an accounting perspective is you generate an alternative minimum tax credit that you then carry forward into the future. And when you ultimately sell the shares that generated the AMT to begin with, you recapture that AMT through that credit. So you're basically what's going on here is the IRS is trying to capture some of the ultimate tax that they're going to be paid at the time of exercise rather than waiting for you to ultimately sell. That's really what it's for, but they're not going to tax you twice. It's not a double taxation. You get taxed upon exercise via the AMT, but then it turns into a credit. And when you ultimately sell, that credit offsets your capital gain tax that you pay in the long run. So, um, nobody likes AMT, but the silver lining is you do get it back. If you do it right, you get it back.
Yeah, and diving into just one more piece on this, and what does this ultimately mean for you? How can you personally strategize around it? What should you be considering? On the incentive stock option front, it's really going to be that time horizon or required holding periods. If you are willing to speculate that you might have enough time before the transaction settles and you believe that they may be greater than 12 months, it may make sense to exercise those shares to retain them for that extended period in order to try and get that long-term capital gains rate. Again, there's going to be a bit of speculation and trying to assess if you think the deal would close in the first quarter of next year, wouldn't make much sense to exercise. If you would determine or believe that it'll be in the third or fourth quarter, it may allow enough time to try and strategize and take advantage of it. Similarly, another aspect to keep in mind from the non-qualified stock option front is going to be potential of income splitting. So the aspect that I alluded to earlier, the spread difference between fair market value and strike price on non-qualified stock options, uh, that is taxable in the year in which you exercise. It may make sense, again, independent, taking a look at your situation, it may make sense to do some of that this year and do the rest of it next year and exercising and receiving that income in order to split and not hit the 37% federal tax bracket, or maybe you could keep each year quite a bit lower. So some aspects to keep in mind on, some of the analysis that we run on our end on behalf of clients and some of the strategy that you can potentially run for your unique personal situation. You've also heard us throw around the term 409A valuation quite a bit. And, what is it at a high level? Why does it impact and what does it matter? Really gets thrown into that bargain element that I was discussing earlier, that spread that's so important for tax purposes. So it's the valuation of common stock of a company and is referred to as the fair market value at that point. Uh, when you are granted an option, it is going to be the fair market value at that point, which creates the strike price or that time period's 409A valuation. Now, you can imagine that given a private company, it's not going to work in tandem the same way you might experience in the public markets. There's going to be some element of discounts and things associated with the valuation of a private company, given it may be illiquid, given it may have concentrated shareholders, for a number of reasons which may alter the valuation of a private company versus that which is freely tradable in public. As I alluded, why does it matter? It really is built into the calculation that is used for tax purposes, that bargain element, whether it be for incentive stock options. The 409A valuation is typically updated about once every 12 months or in association with fundraising events. And the changes to a 409A valuation can lead to some planning opportunities, tax planning opportunities that we assess on our end. And of course, if you have the opportunity to exercise before your IPO or acquisition, bring into focus the long-term capital gains rates and AMT and the things that we just discussed earlier. It's ultimately striving towards trying to lower your overall tax burden, where some of the planning, advice, and strategy can come into play. So ultimate question, how do you actually exercise your options? Well, you pay your company to based on the strike price to buy your options to exercise them. At that point, you may owe some portion of the taxes that are due if you own non-qualified stock options. And at that point, you own and retain the shares. They are now yours. On a going forward basis, there may be additional taxes to be paid, whether it's additional tax associated with the non-qualified stock options or the AMT bill at the end of a tax year, and that parallel calculation is run. There may be some AMT tax due at that point as well. Ultimately, this is the goal of getting you to own and retain your shares.
And this is, partially why planning is one of the reasons why planning this out is really important because, your tax burden here might be six figures plus. Um, who knows? It depends on how big your equity stake is and what your bargain element is, but could be pretty big. And trying to come up with that cash all at once can be pretty difficult. It's likely that you're going to need to plan that out and be strategic about where that cash comes from. Or maybe you need to set up a savings strategy or plan to pay that tax bill over the course of the year. So, don't leave it to the last second. I mean, we often get people coming to us at the very last minute, like, "Hey, I have 2 days before my options expire. Can you help me?" And it's like, not really. The time to look at this was like a year ago. Um, with a short period of time, there's not a lot you can do. You gotta think ahead and you gotta plan ahead. So on that note, there's some risks to this acquisition going through. So I'm going to switch to the next slide that has some examples of mergers being blocked in the past. But go ahead, Eric.
Yeah, of course. So at a high level, and some of the things to consider are some of the risks involved at the company level, and what would that mean for you personally? Considering the broad economic environment, considering the regulatory environment, there are risks involved with the potential of a deal potentially not going through. Similarly, headlines we just saw over the past few days is the postponement of IPOs for both Klarna and StubHub. Things that are broad risks in the market, things to keep in mind that may stand in the way of the neat and orderly acquisition transaction that you're hoping for that may end up pushing some things a bit down the road. Now, as we think about, how confident are we in the current transaction going through? What should we be considering? At a high level, high indicator of confidence is going to be the breakup provision that's built into this transaction. It's one of the largest breakup fees of all time at 10% of the total deal or $3.2 billion. That really shows the company having a strong belief that this is going to go through. Um, at a lower level of confidence, you can look at prediction markets, in this case, Polymarket, as you see off to the right, showing that they expect a very low likelihood that those will be blocked at least before July. Now, reason for low confidence associated with it, very few dollars at play that are actually trying to take a position on this transaction. So not the highest likelihood. We'll likely see this becoming a larger player in assessment of future acquisitions and opportunities as prediction markets continue to grow, but just highlighting it as something to potentially keep in mind.
Yeah, and I just wanted to make a quick comment on the breakup fee. Like a 10% breakup fee is huge. That doesn't happen very often. Like this is a massive breakup fee. And breakup fees are common in mergers. Like there's usually a provision in there that says like, hey, if you guys back out or this thing falls apart for whatever reason, you got to pay us some money because going through an acquisition is distracting. Like it can hurt the business operations. And if it doesn't actually go through, we're going to have to deal with the fallout of that. And we want some compensation as a result. So it makes sense to have a breakup fee. This one is huge, indicating they really think it's going to go through and they're going to really work hard to make it go through. Um, but what if it doesn't? Well, what happens is Wiz would get $3.2 billion in cash as a fee, and then you're free to do whatever you want with that cash as a company. In the case of Figma, where Adobe had made the Figma offer for, I think it was about 20 billion was the acquisition, price or size. There was a $1 billion breakup fee associated with that merger, which then Figma got because the merger was called off. They ended up using that $1 billion, at least partially that $1 billion breakup fee to do a tender offer and provide some liquidity to employees who were, understandably a little miffed that they weren't going to get the liquidity opportunity that they had thought they would get. So just some, you know, there is a risk that it won't go through. But if it doesn't go through, it's not the end of the world. You get $3.2 billion in cash. Maybe Wiz would do something with that related to liquidity options. But it seems like the evidence is pointing towards pretty high confidence that this is going to happen. So that's the takeaway here. Probably goes through. If it doesn't, you get 3.2 billion, and there may be liquidity opportunities associated with that cash injection if the acquisition does fall apart. So how about if everything's riding on the Wiz deal? Uh, does that stress you out? It should. Eric, go ahead and take it away with this slide.
Yeah. So, in association with what John was alluding to earlier of not only the stress that's associated with such large transactions of what it might mean for you personally, but also understanding the concentration risk that comes with having a significant amount of your balance sheet, your employment all tied to one company, and assessing those risks that are involved for you personally. Uh, some of the things that you can do to try and mitigate that risk, thinking about your portfolio and thinking about your balance sheet, trying to diversify it quite a bit more. Thankfully, this liquidity opportunity, assuming everything goes through and goes smoothly, really presents that opportunity to further diversify outside of the single stock, single sector, single industry, taking a more globally diverse approach without a reliance on any one decision going perfectly well. You've done an extraordinary job at working for a company that has grown exceptionally well, continued on that path, and you've been able to be the beneficiary of extraordinary upside that you've seen in your private stock on a going forward basis, do you want to retain all of that uh, risk, everything tied to that company, and ensuring that that's correct on a going forward basis? Or would you rather take that cash in hand, pocket it and understand that in order to provide a more resilient future for yourself, in order to try and mitigate the risk associated with concentration, again, to whether it be one company or one sector, being able to diversify your approach and splitting off the difference between the company that you work for and where you're putting your cash to work.
Yeah, and as sort of the investments guy here, I gotta say a couple things about this. So the first, like if you guys walk away with nothing today, I want you to remember this saying: only a fool gets rich twice. So if you get rich once, you're supposed to stay rich. You shouldn't lose it all. And the way to ensure that that happens is by building a rational, diverse portfolio. Yes, like there's news articles written about the people that YOLO their life savings into a single stock and turn it into millions, but there are no news articles about the people who do that and lose it all. You don't see those ones. And that happens a lot too. So don't get rich twice. You want to keep it. And to do that, you gotta invest in a diversified way. Don't concentrate yourself. Build a complementary portfolio, like it says here on the page here, such that your retirement is not reliant on your ability to predict the future. Like that should not be a requisite for having a successful financial outcome for your life. You need to have a resilient portfolio that lets you accomplish what you want to accomplish, regardless of what happens and regardless of what the future holds. And that's the point of building a diverse portfolio. So just food for thought.
Then taking a bit of a dive into what does this all actually mean for you? We talked through a lot of definitions, a lot of jargon, and now it gets into an assessment of what do these shares mean for you? What does this opportunity mean for you? And how to plan around it for the future. So this really shows just a brief example in terms of some of the analysis that we do alongside our clients to get a look at their holistic tax picture, get an assessment of the client's view and beliefs on the company and their growth into the future, what this cash means for them, how to best maximize it on a going forward basis. Top right really shows the concentration that these shares encompass as it relates to their total net worth, and really trying to make an assessment of how can we plan or strategize not just to reduce the taxation of this opportunity, but to also ensure maximum and beneficial outcomes for that client over the long term. That starts at like the base level of what we think about and what we do at Secfi Wealth. Next step up is really, again, taking that broader investment approach, of which equity is just one component, and understanding that this is really encompassing your broad financial assets, both those on your balance sheet from your investment accounts, this equity, but also incorporating your human capital, where you work today, where you intend on working in the future, and trying to ensure, as John was alluding, that it is not all predicated on you perfectly hitting working for the right company in the future or investing in the right company, but trying to assess how do you diversify those matters. How do you build a resilient investment portfolio to ensure you can meet your financial goals into the future and have it somewhat differentiated from your human capital, where you intend on working and basing your income from to ensure the potential long-term success? We've been seeing a lot of volatility recently. 2020, we saw major shakeups as it relates to the pandemic. In some of the significant rate changes of 2022, we saw major shakeups in many areas of Silicon Valley. And today we're experiencing similar volatility that may shake up a number of industries. And it's really trying to build a financial life that is resilient amongst all this volatility to give you a wonderful sleep at night factor that doesn't have you stressed into the performance of, say, one company, especially your company, and your ability to think a bit beyond just the asset base that you have and really start thinking about your why and what you intend on doing with that capital in the future. So it allows you to hopefully sit back, really wonder, okay, this liquidity event is hopefully really meaningful and wonderful for you and your family, and is allowing you to assess, what ultimately do I want my next step to be? If it's staying at your company, continuing to grow, that's wonderful. But I've had a number of clients come to me and say they want to either take a sabbatical, they want to start taking some more trips in the future. They want to actually put a down payment on the home that they've been looking at. Or one of my favorites that I've heard recently is I really want to delete my LinkedIn and just I want to be done with it. Completely understood the range of desires that somebody has, and whether it be leaving the workforce or kind of changing their future path and gaining some of that financial independence. So it's a matter of determining your why, and something that, we work alongside clients to help assess and then build that long-term plan with them. What we like to do is try to build out that financial life plan, try to assess those long-term goals, build some scenario analysis to say, what if you took that, significant trip a year from now? What if you bought that house and did a little bit of a lifestyle upgrade? And try to make an assessment of what really fits into your picture and how to make these financial resources work their best for you and what you want your future to look like. Because ultimately it's about putting together a plan. So similar to John's quote earlier, one of the things that we want to have as the takeaway or something for you to really consider is trying to assess and understand what this transaction means for you personally. What are your money priorities? What are the things that are top of mind that this new liquidity, this new capital is going to enable you to do, whether it be the down payment on a house, charitable donations, vacations, or that long-term investing focus, or in this case, all the above. How do you achieve all these various goals, bring them all together in that one cohesive financial picture, help you achieve your goals and set the path for your financial future, making sure it's secure, making sure it's resilient and built in a way that is not required to have extraordinary success in one specific company or one specific outcome, but a number of outcomes. So with that, we have a number of tools, as John alluded to earlier, at secfi.com. Feel free to dive in, read some of our educational content. And if you find that it's right to strategize around this situation or your next opportunity, we are all available to jump on a call and discuss your personal situation, individualized situation at greater length.
Awesome. Thanks, Eric. There were a handful of questions that came in during the presentation, and one in particular I wanted to make sure we addressed out loud. Tim wrote up a great response, but the question was specifically, is it worth exercising remaining options now, or is it too late? I want to avoid short-term capital gains tax, but it seems like I may have missed the window. That was the question. And the answer is it maybe. So unfortunately, it depends. So you if you exercise now and the acquisition closes on April 8th, 2026, you'll have long-term capital gain treatment. If it closes before that, you'll have short-term capital gain treatment. We don't know when it's going to close. So there's a bit of a risk that you're taking if you exercise now. It may or may not result in a lower tax burden overall. So I want to state that categorically. We don't know when the transaction will close, but the holding period requirement is a requirement. You have to hold post exercise for a year, for longer than a year, so 366 days. Um, and the other thing I'll note here is, Eric mentioned this during the presentation, but just because you're not getting long-term capital gain treatment doesn't mean that there's still not tax optimization to be done. So, for instance, just as a hypothetical, suppose the 409A now is low relative to the acquisition price and you have an opportunity to exercise now when that bargain element is lower because the 409A or fair market value is lower. That's going to drive income in 2025 into your tax return. You'll be taxed on that at ordinary income rates, but it'll be but perhaps that's better than getting taxed all at once in 2026 when it closes at the higher price. So there's still things to do that can save you meaningful money, even if it doesn't end up being an early 2026 transaction close. So don't write it off. Understand that there's a risk there, but don't write it off completely that just because, it might close earlier doesn't mean you can't do anything to optimize on the tax side. You still can in a lot of cases.
I just wanted to add a brief note to that, and definitely going to be highly personalized. But again, working off of potential hypotheticals, there are thresholds in which you may be able to exercise incentive stock options without an AMT burden being associated with it, where you may not have additional AMT. So again, it's going to be very personalized and very specific to your situation, your full tax picture, but there may be a situation in which you can actually exercise incentive stock options and retain them with no AMT tax bill in the event that it extends greater than a year before the transaction closes, where you're not taking on a substantial amount of risk today to potentially get that long-term capital gains treatment. Again, very individualized and personalization dependent, whether it be working with your advisor or CPA, but wanted to keep that top of mind as well.
Yeah, great. Don McQueen asks a question. He says, so if you pay for options today, you pay AMT in 2024. Then if the deal closes before the year window, of like the long-term capital gain window, I'm assuming, you'll lose the opportunity cost, pay AMT tax, and short-term capital gains. Uh, Almost. Eric, do you want to address this one? You're better placed to talk specifically, but basically, I think he's asking like, if I'm forced into a disqualifying disposition, do I lose the AMT tax? Like, what happens to the AMT tax that I paid? How am I ultimately taxed?
Yeah, so any AMT tax that is paid, as John alluded to earlier, in years in which your regular tax is much greater than the AMT that year, you will receive back that credit. So it's not, the strictly tax or the cash out of pocket that is entirely lost. The opportunity cost is simply the payment or where that cash would other be utilized, whether it be it's sitting in a high yield savings account or elsewhere in your brokerage account. It's essentially utilizing those funds in order to purchase these shares in the near term. So yes, there may be short-term capital gains that may end up getting paid in the long run. The only real opportunity cost and then near term would be where would that cash be otherwise utilized, whether it be again in a savings account, checking account, or brokerage account.
Awesome. Thanks for explaining that, Eric. We got another question that is any speculation on the per share price? Well, let's do the math. The last round, according to Caplight over here, valued the company at 12 billion, which was 21.52 per share. So if it's going to be a $32 billion acquisition, that puts the acquisition price in the order of about 55-ish dollars a share, give or take, a few bucks a share. There can be other things that influence that, like dilution. I'm not even 100% sure. You know, maybe Caplight has the share count wrong, but I think like kind of anchoring in the 50 to $60 per share range is probably going to be pretty close um, in this situation. So yeah, that's my speculation on the share price based on the last round's price per share and valuation, and the purchase price. It's probably going to be around 55-ish per share. All right. Well, with that, we have no more open questions in the queue here. So just want to take the opportunity to thank everybody for attending. Again, please reach out to us if you'd like to talk more. We work with folks at a bunch of different companies with private equity compensation. And we're happy to talk to you too, see if it might be a good fit for the long run. So good luck with the acquisition. We'll be here to answer questions along the way. If you ever want to reach out and have a discussion with us, we're here for you. Have a great afternoon, everyone.